because ultimately you're managing money. It's not your money. It's someone else's money. You're managing money for a client, and they're going to be like, well, why are you selling the stock we don't even own in our account? All right, guys, let me get going because I got a 1 o'clock meeting I got to get to, and I'll see you all tomorrow morning. Thanks, everyone.
Okay, folks, what's going on? It's Rodrigo here. We have a session here that we're going to give you guys a live session here with Mark Putrino. We're just going to wait for Mark to pretty much get here in the zone, and he's going to be with us talking about trade ideas, education, what happened in the school, because we did have a class there, a live class. So he's going to be here with us shortly. I'm giving, he already has the links and all that stuff. So just give us a quick minute and we can get this all set up here and going. All right, folks. So here we're going to, well, I was showing you a little bit of the Benzinga Trading School demo, but we're gonna have here Mark Putrino. We have him in the building, and he's gonna be here with us, basically going over the trading school and a couple things there. So I think we have Mark there, Mark Putrino in the house. How are we doing, sir?
Hey, Rodrigo, how's it going?
Hey, man, not much. How was the class today?
It was good. It was good. We got some profitable trades in from some stuff we looked at yesterday. A little bit of some of these oil stocks turning over a little bit. Today was our momentum class, though. We were talking about momentum. So for those of you who don't know, the way our class works, and you can see the classes there, we have pretty much 8 principles that we focus on. And we have 8 classes, and each class focuses on one of those principles. For example, today we talked about momentum. So we would talk about various momentum indicators, how they can be used, what's their application. And we look at momentum because when things get to extremes, what we call overbought or oversold, we tend to get reversals. right? And that's where we get a chance to make some money. And that's a matter of fact, Rodrigo, that's what happened with a couple of the profitable trades we looked at today. When things got overbought, and then we played them off the reversal.
Right. And what are, I know that you've been always, going over different sorts of trades. I mean, that Kimberly-Clark trade, was a big winner. Maybe you want to show your chart so that we can kind of talk, see it a little bit better. But that short on Kimberly-Clark worked out pretty well. So where do you see Kimberly-Clark going on?
Well, let's see. All right, so the reason why we thought about shorting this, if I remember correctly, is because there's a saying on Wall Street, right? It's that gaps refill. And we saw this here, it gapped up. What gaps up, gaps down, or what gaps up can get down. So that's why this looked attractive as a potential short idea. And there's a reason why gaps refill. It's not just Wall Street folklore. There's a principle in markets where levels that had been resistance can turn into support. And the reason why that happens is because people experience seller's remorse. They sell something and they watch it go higher and they tell themselves, you know what, I shouldn't have sold that. I'm going to buy it back. But I'm only going to buy it back if I can get it for the same price I sold it at. So you have this phenomena where you have people that, and I can show you a clear example on a different chart here. All right, so here we have an example of, we can see here support becoming resistance. So let's talk about this first. So people buy here, and assuming they still hold it, it goes lower, and we have people that regret buying it. So they say, I want to sell this. I made a mistake, but I don't want to lose any money. So I'm going to sell it if I can at the same price that I bought it at. So we have the situation here where support turns into resistance. Well, we also have another phenomena in the market where levels that were resistance can turn into support. And that happens because of not buyer's remorse, but seller's remorse. People sell, they watch the stock go higher. They tell themselves they're going to buy it back, but only if they get it for the same price they sold it. So when you have a situation like this, where you have a big gap up, there's no trading in here. So you don't have people that were selling it saying, darn, I shouldn't have sold it. I want to buy my stock back. So there's not going to be a lot of buy orders in this range. So we can see here, things that gap up tend to gap down, or gaps refill. And this is an example of it here. So yeah, so that's what the thinking was on that. So we were trading at a support level right around 138, and that would have been our warning sign. It's like, hey, wait a second, this thing is trading above at support, but it's trading just above a gap. It's trading just above this like air pocket. If this thing starts to go lower, there's a good chance it could refill the gap. And that's exactly what happened here. And our buy price to cover this, because this was a short idea for puts, would have been down here, because levels that were resistance can turn into support. So we have a resistance level here around 127, and it became support. So understanding where these important levels are is one of the keys, maybe the ultimate key to successful trading, right? If you don't know where these levels are, you're basically just like you're operating blind, right? You got to know where the levels are important. And the institutional trading world, where my background is, I spent time trading for Mario Gabelli and Steve Cohen, and then I was a head trader at 3 different money managers. So I can tell you, in the institutional world, there's really no like secret systems or anything like that we use. We're looking at things that are overbought, oversold. Stocks that are overbought that get to the resistance levels tend to sell off. Oh, it's probably another thing here with Kimberly-Clark, right? We got up to a level that had been resistance in the past at the same time as it was being overbought, right? Every stocks have like what you would call a personality or a characteristic trading range, right? And they spend the vast majority of their time within that range. If something gets aggressively bought to the point where it gets above that range, we call it overbought. If something gets really beaten down hard to where it gets below that range, we call it oversold. And why do we care about that? Well, we care about it because stocks that are overbought or oversold tend to reverse. It's almost like a rubber band, right? It gets overdone here. This thing on the bottom of my chart here is what we call our RSI indicator. It's a relative strength index is what that stands for. And this measures momentum. And as we can see, when we get the blue line gets below the red line, that tells us that the conditions are oversold. And if the blue line gets above the red line, that tells us that the conditions are overbought. So that's what we were looking at today. Today's class is momentum. I'm sorry. Yeah. Yeah. So that's today's class. So look at this. So we get oversold. It turns out it was a great time to buy. We get overbought. Turns out it was a great time to sell. And this illustrates a principle of markets very well. Markets that are overbought, that get to resistance levels, tend to sell off. And that's what happened here. So that was this situation with that. So just by focusing on which price levels are important, what's the momentum, having an understanding of gaps, but that comes with the understanding of price levels, and understanding this momentum allowed us to make a profitable trade idea here. So Rodrigo, you told me you were in this, right?
In Kimberly-Clark, yeah, but that was when like when you initially posted it. So
Yeah.
like when you first posted it, it was at 138, and basically, like the implication was, this is going to fall. So yeah, I bought some options on it, but that was, like when you first put it out,
Yeah,
So
cool.
where do you think it's gonna go? What are the possibilities now?
I mean, I would be watching this support level here at 128. Resistance becomes support. And if this breaks, it could go lower. And I think the markets to me are looking pretty weak. I think we're going to go lower. And tomorrow we have the consumer price index being reported. And obviously everyone's going to be paying attention to it because the big issue now on pretty much everyone's mind is inflation. And I just don't see how the number could come in and how Wall Street is going to consider it good, right? It's either going to come in above or at or above expectations, and people are going to say, wow, that's really high, inflation's really bad. Or it's going to come in below expectations, and people are going to say, that's a sign that the economy is slowing down. So I just have a hard time thinking of what could happen that's going to make the market go up. And what's important to look at here, and this is one thing we look at every day in the class, is the S&P 500 ETF, because this tracks the broad market. And you can see we've been in this range for, going back to May 27th. And today, we're testing the bottom part of this range. So conceivably, the CPI comes out bad, the support breaks, and we get a decent move lower. I kind of think that's what's going to happen. But we always let the market tell us what to do. If it looks like we're going to rebound and this level is going to hold, then we can jump in on the long side. We try to have an agnostic opinion of the market. I mean, it's fun to talk about where you think it's going to go and everything. But if you get too set in your thought, like, oh, I think the market's going to go down, it's going to go down, it's going to go down, you'll get subject to confirmation bias, where you're basically only going to see things that you want to see. And you're going to tend to not put enough value on things that you don't want to see. So we look at this every day. This is pretty much where we start. We look at oil pretty much every day. Let's take a look over here, because this gives us an idea of what's going on. Now, this is kind of interesting. Notice how oil is reached the peaks that it got to when the whole Ukraine thing started out. So there's a good chance there's going to be some resistance there. A lot of the students trade natural gas, and they don't actually trade the natural gas future. They trade ETFs that track natural gas or trade inversely to it. So for example, I know we had one student who I believe when natural gas was up here, took a position in this ETF that trades inversely. And the symbol of that is cold. Whoops, cold. KOLD, cold, because it's natural gas. So this particular ETF is designed to move in the opposite direction of natural gas, right? So if you think natural gas is going to go down, you can buy this because this will go up. There's also this other ETF, BOIL, that will go up at twice the rate. It's a leveraged ETF. So we have a lot of students that trade these commodities, but they're not actually trading the futures directly. We're trading the ETFs. So a lot of students, when they first come into the class, are even a little bit surprised. And it's not even students. I meet a lot of people that don't realize that there are ways to profit in down markets. You don't need a sophisticated dividend strategy, or you don't need to buy options. There are ETFs that go up when the market goes down. So if, for example, if SPY starts to break that 408 level that we were looking at, and it looks like it's going to go down, there's an ETF, the symbol is SH. This will trade inversely to whatever the S&P is doing. So if the S&P starts to break down, you can tell that the charts are like mirror images of each other, right? So there's SPY, and there's the inverse. So if this starts to go down, this will start to go up by roughly the same percentage. There's also, for traders that are more aggressive, this is a lot of the students trade this one, and I think you made some money on this too, Rodrigo. If the market goes down, this will trade 3 times inversely to the NASDAQ 100 index. So the NASDAQ 100 index is the 100 biggest stocks on NASDAQ that are not in the financial, sector. So if the market starts to go down, this is going to go up 3 times as fast. For people that are super aggressive, they can even buy options on these things. So, trading is about understanding the markets, but it's also understanding like what vehicles you can use and what's the best way to allocate your capital. Like where's the best bang for your buck, so to speak. So a lot of the students have been very successful with these inverse ETFs. And you know what? I'm just going to ask you guys to just hold on for 1 second, because I'm going to shut my door, because I think our landscapers are here. So I will be back in momentarily.
Guys, in the meantime, while Mark gets back from doing that, for all you guys that are asking, not just so on the Twitter space, because we're running a couple things here. For the people on the Twitter space, we put the link to join the trial. It's a 7-day trial with Mark, $7. We put the link on the Twitter space. You're going to see it there. And for all the people that are on Zoom, on YouTube, we're going to post the link there as well. It's $14.97 after the 7 days. If you want to pretty much trade with us, right, in the trading school and go through the lessons. We'll touch on that later. But yeah, folks, I'll put the link there.
All right, cool. So let me just go back to the principles then of the classes and the way we designed the class the way we did. There's, in financial markets, as we can see, there are certain price levels that are more important than others, right? And I believe that as long as there are financial markets, that will be the case. We could see for some reason in the technology sector, Spider 164 was an important level. We see the concept of support turning into resistance here. So the second class, the first class is like the introduction and the philosophy. The second class is we talk about levels, why a level might become important. Why would this happen? Why would a support level turn into a resistance level? But then what we do is we look at the actual market to see if we can take some of these principles and apply them in a way that's profitable, right? A lot of technical analysis is books, right? Or people saying, oh, look at this trade I showed you last April. It worked out perfectly. Well, this is different because we're looking at the market in real time. So we'll spend, say, maybe, I don't know, the first half an hour of the morning class talking about, what's the support level, what's the resistance level. But then we look into the actual market in real time to see if there's a way we can figure out a way to trade. For example, if this starts to break down, when we got down to around here, I think it's probably going to be a time to buy it, because it was support back here and it was support here. For some reason, I don't know why, I guess only the market gods would know, 131 just happens to be important. All right. So that's our class one. Class two is, or actually that's class two. Class three is trends. We just have to understand why trends work the way they do. Markets are always trending. They're always going up, down, or sideways. We have our class on momentum, where we talk about things that get overbought or oversold. We have our class on market psychology, because that's one of the big things. That's the big reason why most people fail, is because they get emotional and they guess, or they let their emotions make their decisions. We have a class where we talk about how to build trading models. And then what am I missing? Then we have another class. The eighth one is the how to look at the market in a broad overview, kind of like we're doing here. But let me just kind of give you a little example, if you guys can think about this. And this kind of illustrates how, like, the media is vastly wrong. The vast majority of the time, what they're telling you on CNBC is not true. It's like, why is the market moving, right? And I can show you a perfect illustration of that here. So when the tech sector was moving lower, well, actually, let's go back to the S&P 500. Now, this is where Russia went into Ukraine, like right here. So the market's down, the market's down, right? They're saying Ukraine. Well, things are even worse in Ukraine, and then the market went higher. So if Ukraine was driving the market down, how is it possible that the market could be going up when nothing's changed? So we thought there was going to be a bottom here, and it turns out there was. And the reason why we thought that is because we looked at the technology sector, which is the biggest sector in the market. And when this sector reached a level that was resistance in the past, the level converted into support, and it looked like it was going to hold. And, this is why the market bottomed, at least here, is because the big sector reached a level that was important. So the vast majority of the stuff you hear in the media is wrong. It's very hard to have a fundamental story that actually moves a market. Something like an interest rate or an inflation thing like tomorrow, like that could have a serious impact. But you just hear all this nonsense. Like yesterday, like they're saying, the market's down because comments that they're making at the SEC. And it's like, no, it's not. The market was down yesterday because we had a reversal off of a level, right? It looked in the morning like, once again, SPY was going to test this 415 level here, which has been the top of the recent range. And when it didn't look like it's going to get through, the market reversed, and we had some momentum traders jump in here. So it had nothing to do with whatever they were saying over at the SEC about payment for order flow. So by knowing where these levels are, it's like a map. If you don't have charts, it's like you don't have a GPS system and you don't have a map, and you're trying to drive around in a town that you've never been in before. So that's what we use these charts for. And when things reach important levels, they tend to make big moves, or they tend to either rebound off of them or break and go down. They don't typically spend that much time trading in a range like we've seen over the last 2 weeks. But like, right, back here, right, market gets overbought, it reaches a level that was resistance before. So it's all in the now this is one of the reasons why I'm bearish, and I'll show you guys this. So Apple is the biggest stock in the market in terms of market cap. And Apple is trading below this very important 151 level. So why is this 151 level important? Well, I don't know, but we can see it was resistance back here. We get a sell-off, and now we have this concept of levels that were resistance converting into support. People sold, they watched it go higher. They tell themselves, I made a mistake, I'm going to buy my stock back, but I don't want to pay more than I sold it for. So I'm going to place my buy order at the same level that I sold at. So if there's enough of these buy orders, the level that was resistance can convert into support. Apple goes higher, breaks down through this. Where does it find support? At a level that was support before. Rallies, where does it hit resistance? At a level that was support. People bought here. See, this is seller's remorse. People sell, they watch it go higher, they try to buy it back. This is buyer's remorse. People buy, assuming they didn't sell. When it falls below the price level they bought it at, they tell themselves, I want to sell. I made a mistake. I shouldn't have bought this, but I don't want to lose any money. So I'm going to try to sell it at the same price that I bought it at. So if there are enough of those sell orders, the level that was support converts into resistance, like we see here. So until Apple gets back above the 151 level, assuming it does relatively soon, I can't see how the market could go higher. So this is a really important thing to focus on here. But again, we see these, this importance of these price levels, right? It's really kind of bewildering, frankly, to think like, how could a market that's this big trade to such clear levels? But it does, right? You can look at pretty much any chart and tell. So this is pretty weak. Another thing I'm keyed in on is the financial sector. We look at the S&P consists of 11 sectors, and we look at each of the sectors because sometimes by looking at the sector, you can get insight into where the broader market's going. It's like looking underneath the hood of the car, so to speak. And if we look at our financial sector, which is typically pretty important, look what happened here. We have support around this 36 level. The support converted into resistance here and here. And now we're trending lower. So this is pretty weak. This is pretty weak action here in the financial sector. And this is an important sector. They're all kind of important, I guess. But so this is some weak action here. Tesla, we could look at, because this is one of the bigger stocks. And we can see that this resistance here is at 765. So support turned into resistance. So if you happen to buy Tesla down here, and assuming that you're a trader and not someone who's buying it to put away for the long run, you buy it here, it starts rallying, and you might start to ask yourself, well, gee, where should I sell it? Well, you look back into the past, because that's what this is here, and we see, 765 was support. That's where I'm going to have my sell order, because there's a good chance it's going to be resistance. And sure enough, look what happened. Support turned into resistance.
And someone's asking, about levels. Mubin, we have a full chapter called Levels. Literally, we have 8 chapters total: momentum, levels, trends, investment psychology, which is my favorite class, the psychology part. But a really special person here in the chat, born to be free, from the school. So he said, could you pull up AERC? He's got a small position in it. So this is an actual student, born to be free. Born to be free, man. He's look, I got to say something before we continue. The community here is, I'll tell you, it's one of a kind. It's a great community. Mark knows it. People have fun in the school, and they make money and they learn. It's really nice. It's really nice. You guys should check it out.
Yeah, so this is interesting here, because a lot of times when you get these big moves higher, it's because something happened in some chat room somewhere, and they're not sustainable. Like I would imagine that something like this was probably some chat room driven thing, but this is a little different because this is new. This is news. This is driven by news. The company got FDA clearance, so their shares are rising. So, this is a different thing than something like this. So I would say, there's a good chance it keeps moving higher because maybe this news is some kind of a game changer. In terms of if you're trading, where a potential price target could be, I would say at 14, because it was a top here. And on this particular day, which was Tuesday, yeah, look at where the high was, right around 14. So there's a good chance if it keeps moving higher, it's going to hit some resistance there. But what we could do is, if we would go to the AeroClean website and maybe start looking at some of their financials and see how impactful this news really is. I mean, does it really change the whole valuation of the company? Is it, is it worth the company being 5 times the market value of what it was before the news came out? But it's a different thing, when you get a spike that's driven by news. So in a situation like this, what we could do is, we can go to the company's website and look at their investor relations page. Let's see if I could find it. Sometimes it's easy to find these things and sometimes it's not. AirCap, that's not it. Well, anyway, we could go and we would look at the company's financials and try to get an idea of whether this news is going to have a real solid impact. So AeroClean Technologies. Let me see if I can find it this way. AeroClean Technologies IR. Investor relations. All right, so we could come here and, I'm not saying we're going to do it now, but we could look at the news and see what's going on. All right, so let's see. They announced an appointment of this new guy as a vice president of sales. So that could be a good story, bringing in a new salesman. We could look here. This is the actual news story. And then we could probably try to figure out how much of this company's sales would be of this product, and to try to get an idea of what the valuation is going to be. So I don't really know very much about this, but this is something that we could do. We would look at their other products. All right, so it looks like they only have 2 products. And I guess this is the one that just got approved. So there's, we come up with our ideas in different ways. But that would be the way I would go about looking at this. I mean, this could be, a real game changer if they only have 2 products and one of them just got approved. So every company has, well, not every company, but most big companies have an investor relations page, and it's a lot easier than most people would think to find out stuff about the company. Like this goes back to November, but this is all about the company, the history of what they do, the people, intensive R&D over a 7-year period, patented, management team, talking about how big the size of the market is. So this would be good for like schools, right? Especially with the whole COVID thing, maybe that's a play. Returning to normal life. Yeah, so this is like a COVID play. So I think this could be potentially a game changer for this company. And that's probably why it's up so much. All right, so I got some more questions, Rodrigo.
Yeah, so that was well, that's a trade that one of the students is in, and it's a pretty good example to show people really that I mean the trading school is live. You're there with the students the whole day, and you go through charts with them regularly, right?
Yeah, it was what we do. We go through the market every day. We look at the different sectors. We look at commodities. We look at the headline news stories. A lot of it is kind of just like brainstorming to see if we could come up with ideas. And
Yeah,
this
and,
goes
and
back to our whole concept of letting the market tell us what to do and not just trying to guess. And like we have to let the market tell us what to do. And for example, if the market starts telling us that this level on S&P is starting to break, well, that's the market telling us, hey, the market's going to go down. So we're not guessing. We're letting the market tell us what to do, and then we would act accordingly. Maybe buy some of those inverse ETFs, or some of the option traders might buy puts. So we come up with trading ideas in a variety of different ways. Most of it's probably technical, but there are other ideas that there are other things that we look at too, like looking at earnings. Today we were looking at how much the inventory has increased in Target, and looking at some of these other companies, because increasing inventories is a bad thing. It basically just shows that companies aren't selling as many products as they used to. So their inventory is climbing. So this is something we look at. This is the SEC, and this is not Target. Actually, I'll show you the Target story and why this news probably shouldn't have been that big of a surprise for some people. And just to show you guys, this is the news that made Target drop from 211 down to here. All right. So the company's earnings declined because their inventory is building. So where would you see that? Well, we can go into the financial statements, and that is going to be on the balance sheet. So if we look here, we can see that last year in May, they had $10.5 billion of inventory. Now they have 15 billion. So they've increased their inventory by 50%. But this shouldn't have been that big of a surprise, because an astute analyst would have picked up on this. In January, when they put these numbers out and they said, wait a second, we've gone from 10.5 to 13.9. We're having a significant inventory buildup here. So this didn't come out of the blue here. This didn't come out of the blue. Astute analysts would have seen that. And, some did, right? There's a buyer for every seller. Someone sold here and someone bought here. But this news really shouldn't have been that surprising to someone who follows this company closely.
Right. Really quick here, Mark. My people are sending a bunch of emails, questions about the school. So I'm just going to go over this really quick, and then we can get back here with the session. Just be
all right.
like
I'm gonna give you the screen back then.
No, you're good. You're good.
Okay.
Yeah. Just so these are the questions from you guys from the chat that have sent this. So all right, folks. So does Mark Putrino go over student trade ideas? Yes, we just went over one from Born to Be Free. Let's see. We do that every day. It happens all the time, right? Are the sessions on Sundays? Are the classes recorded? Yes, all the classes are live, but they're also recorded so that if you miss it, you can also watch it at a later point in time. If maybe you have a full-time job or you're out, for any reason. Does everybody that joined the school get a free laptop? Yes. Is this for new traders only? No, we have new traders and advanced traders. Keep in mind, Mark Putrino has traded with multi-billionaires like Steve Cohen and Mario Gabelli. Like, this is something pretty good for all sorts of traders, right? What is the schedule? Okay, so from 7 a.m. to 9 a.m. Eastern, you have the first class, and then from 12 to 1, you have the other session. That's Monday to Thursday. Friday, you meet from 7 to 9 a.m. That's the overall schedule, right? There's 8 chapters, and you're going to see each a chapter Monday, Tuesday, Wednesday, Thursday. Friday, it's just a recap of the week. So good question there, Phil. let's see, is there a money back guarantee? Yes, 7-day money back guarantee. It's $7 for 7 days for the trial, which is what you're going to see on the link on Twitter Space, on that link, or on YouTube or on Zoom. But after the 7 days, if you want to keep it, it's $14.97 for the year until, that's until we have it there, I believe, till midnight. So, all right. So good question. What is the price at renewal? So next year, it's going to be the same. It's not going to increase, never. So mobile user friendly, yes, it is. So I think that kind of covers everything. I know that you've added a couple things there, Mark, like a weekly session, something like that, where you're going like, what to look forward to in the week, something like that.
Oh yeah, well, it's just a little newsletter I put together over the weekend for people just to get an idea of what we're going to be watching going forward, and like what are the most important things to be looking at going forward, and that comes out on Monday mornings. So it's usually, I don't know, 10 to 15 pages, maybe 20 pages.
Right.
So I just wanted to show some of the people that are listening this ETF here, because we're talking about inflation. And this is kind of really illustrates that there's a lot of different ways to profit in the market. And this particular ETF is designed to follow a commodities-based index. So if inflation keeps going higher, this is going to keep going higher. So people are talking about how much money they've lost because the market's down this year. But had you bought this in December at 20, now it's at 30, you're up 50%. So there's a lot of different ways that we can approach what's going on. And as traders, we like chaotic markets like we have now, although the stock market's been relatively quiet and range bound over the last 2 weeks. But yeah, so yeah, this is another thing. Like, people don't understand that they can actually profit from inflation, or at least hedge. I don't know if I would consider this like a trading idea. This is more of a longer term idea. But if inflation keeps going higher, this is going to keep moving higher. So, and I think inflation is going to move higher. And I think it's worse than people say, because I watch this a lot. This particular index measures inflation. Okay, it's a different way to measure inflation. We're talking about the CPI that's coming out, the Consumer Price Index. But this is a basket of commodities. Now, let me ask you all something. Now, the way I learned how to do math, I don't know if they've changed it since I was in school, but this commodities benchmark, it's up over 50% in the past year. And here's the CPI. So this is what the CPI would look like at 8.5%. This is up 50%. And notice that I have these scale here logarithmically, which means these are all equal by percentage moves. Not only is there no signs of inflation slowing down, we can even argue that it's accelerating. It's going up at a steeper angle here. And this is, this is oil.
Mark, how is that possible? The Fed says it's 8%. Like, how is that?
I don't know, bro. Maybe Janet Yellen will cover it in her new biography that's coming out.
We got a discount for Powell. Anybody that works at the Fed, look, if you are trying to get some education, we have a special Fed discount for you here.
No, man, they got to pay. They're costing us money, Rodrigo. So we, by making the price of everything go higher. But all kidding aside, I mean, come on, these are the same people that have been wrong for so long. I first started writing about inflation in August of 20. So going on 2 years ago. And what I saw back then, which made me, and I do show the students this articles. It's from a place that I worked at previously, but it was published in August of 2020. So this is the price of copper. All right. Copper is it's a good benchmark for inflation. It's a very widely used thing. So this is where I first wrote about inflation. It was in here. All right. And what I saw was that copper prices had climbed from, say, $2 to $3 in a matter of months. Right. So for these people at the Fed to say, inflation's transitory, they didn't see it coming. I don't know how they could not have known that. I mean, how they could be surprised or to say it was inflationary. Sorry, to say it was transitory. I mean, by definition, all inflation is transitory. So it's just like a play on the words, because eventually it'll end. But so we have the same people that messed everything up are the same people that now we're thinking naively that they can fix everything. So it's like it's like a guy's an arsonist and you're making him a fireman. I mean, it just seems to me like we don't have I don't have much confidence in the people that are running the show. Let's just put it that way. But
well, I mean, it's the same thing. It's all, I mean, it's like the Fed's always involved in these things and like pumping money one way or another. And then, but this is pretty serious because now like you have so many other things, Mark, like not just, inflation, but you have, GDP contracting and a lot of things, with food prices, oil prices, the consumer. I mean, it's more than just inflation. You agree?
Yeah, but I think a big part of the inflation is energy. Energy is what's kind of messing everything up because everything needs energy, right? If you're a farmer and wheat prices get really low, well, maybe you convert some of your land over from wheat to rice, or something like that, right? So the market on other commodities supply and demand could bring them back into equilibrium. But the difference with energy is that it applies to every industry. I tell people, like, look around the room that you're in right now. Everything that is in the room you're in right now was in a truck at some point. All right. So energy goes higher. Diesel prices are at all-time highs. That just blows through to the entire economy. And it has these unintended consequences. Listen, I'm not a political scientist, but I don't think Vladimir Putin would have invaded Ukraine if oil was still $40 a barrel, because he couldn't have afforded it. I think the Russian economy has to have oil around 68, 69 to balance their budgets. Or oil is their biggest thing. We have famines breaking out in Africa and the Middle East because wheat prices are so high. We got this whole, I don't know if this whole baby food formula thing is related somehow, but that's the reality of higher energy prices. It bleeds through to every part of the industry, and it's not just, think about trucks, right? It's not just diesel. Like my stepfather owns a garbage business, right? They have to, those trucks are really heavy. They have to replace the tires every 6 months. The prices of tires, they use oil to make tires, right? So the price of oil or the price of tires has doubled in the last year or so. So it's pretty bad, dude. It's pretty bad. And I think it's kind of it all ties in with this, not drilling oil and the energy policy. And I don't know, it just seems like it's a lot of unforced errors, if you ask me. But all that being said, yeah, I mean, energy flows through to everything. And the only thing it seems like it's going to bring it down at this point is when the economy slows enough that there just won't be the demand for it. I mean, at what level do people say, gas is now $5 a gallon? I'm not going to go on my trip this year. We're just going to stay home. Or, people that have to drive a lot, how it's eating into their profits. So, so I don't see things getting better. I don't really see anything to be bullish about, even from an earnings point of view or a valuation point of view. The market is still overvalued based against historical norms. Like for instance, the S&P 500, whatever the price to earnings ratio now, is still higher than what it has been historically. So there just really doesn't seem to be too many things to be bullish about,
right,
at this point. So that's why we look at the inverse ETFs like SH as triple Q, because if the market goes down, those things are going to go up.
Hey, really quick, Mark, just want to give a shout out here. Ninja Trader, welcome to the family.
Welcome, Ninja Trader. Yeah. So, yeah, dude. So, it's diesel, it's natural gas. Natural gas is at like what, a 13-year high or something like that. But I really like to look at this chart, and because it helps put things in perspective. Now, this is the Dow Jones Industrial, right? And I'm going to go to the entire history, which goes all the way back to 1897. All right. And the reason why I want to show you this is because if you've only been in the market since, say, 2011, you've never really seen a bad time. Like, say you got in here March of 2011. From a historical point of view, or at least from a market point of view, this is the COVID crash. This was like an anomaly. It was literally a month, over in a month. So people that go through this come out of it with the mindset of, oh, whatever, if the market goes down, it's going to come right back. But if we go back through our country's history, we can see that, well, first of all, if you just look at this, you can see what we've been through is just a blip on the radar screen. I mean, it doesn't even show up longer term, right? But sometimes markets can go down for longer than people think. Like, this is around where I first started in this business. And, the market peaked in, let's call this February of 2000. Where did it bottom? April of 03. So that's a 3-year sell-off. All right. This is the financial crisis. This was a year and a half. Let's go back here. And this is, there's this whole myth, and it's a myth, that you can't time the market. You can time the market if you know what to look at. Buy and hold is another myth. All right. Buy and hold is great when you're in a 10-year bull market, right? Look at this. The Dow Jones first hit 1,000 in 1966, 1965. It didn't break it until 1982. So if you were buying and holding, you were holding for a long time before you saw any money being made. But this is all oil driven, right? This is the Yom Kippur War, knocked the market down 50%. This is the late 70s inflation. This is when they actually jacked up interest rates to break the inflation. And then look what happened. We went into this big, long bull market here. So yeah, it's, we have to keep things in historical perspective. Markets can go down for longer and farther than people think. I mean, just look at GameStop. I mean, we were looking at this morning, like when it had that collapse last year, it's down 90% off its highs. We started really talking about this in November, and that's when the market really started to get weak, was in November. But there were signs of danger throughout different areas of the market. Like, different things go down at different times. Now, the first thing I would say is that the garbage companies, the companies that all the Reddit, well, not all the Reddit traders, but that like a lot of the Reddit traders pumped up. Let's see, what's ATR is one of them. Oops. ATER. Well, anyway, my point is that a lot of these so-called Reddit stocks, or the meme stocks. I'm going to just put this onto here. All right. So a lot of these companies, there's a lot of charts that look like this, right? I mean, this stock went from 47 to $3. All right. But it went from 47 in February, and it was trading at 7 in August. So this is a full-blown crash. And a lot of these Reddit stocks look like this. And these are the guys all started to blow up like at the end of last spring and over last summer. So these were one of the first signs of weaknesses that we started to see. by November and December, big parts of the market had already crashed. You know, there's a lot of charts of things that look like this. Another thing that we look at is, now, if we look at this, all right, this is where we first started to see that we were going to get into trouble. Now, what was going on here is that if we look at the technology sector, all right, the tech sector peaked in late December, okay, the technology sector. Now, what's going on here is the way these benchmarks under these industry indexes are constructed, they can mask a lot of the selling that was going on, because here's what's going on. People are selling all their stocks and they're putting their money into Apple and Microsoft and the stuff that's considered safe. Because Apple and Microsoft have such a big market weight, they're 20%, I believe, of this sector together. It masked all of the underlying things that were going on that were bearish. Like if you were just looking at this, you wouldn't have seen that all those Reddit stocks and the meme stocks had crashed and so forth. All right. So if we look at a technology index that has an equal weighting of all the stocks, so we don't have two stocks dominating it, we look at this, and now look where this peaked right here. So this is in November, whereas the other peak was here. So this was a sign right here. You know, we broke our uptrend that things were going to start to get bad. But again, the benchmark indices, the way they're constructed, they kind of mask a lot of the underlying stuff that's going on in here. So we talk about different parts of the market peaking at different times. So we just saw technology peaked in late January. We could look at our healthcare sector. Look at where healthcare peaked. Not until April. Okay. We can look at our consumer staples stocks. Where did they peak? They didn't peak till April either. So the market goes down. Different parts of the markets go down at different times. So this whole sell-off really is not anything that caught us off guard, because when you look at the market every day, these are the type of things that you see. So that was pretty yeah, so we really started to kind of shift our tone to bearishness, I think, like around last November, maybe early December.
Right. And there's a lot of stuff that, you know, in the school, overall you go over, right? Like technicals. So as far as like the investment psychology class though, because I don't think it really gets discussed much or anything, but it's, you know, if really that's not in check mark, then I guess it doesn't matter what you do as a trader. If the psychology is not there, if the mindset's not there, it's not going to work, right?
Yeah, because most people, you know, like I say this, like trading models are like having a home gym. You know, it's great in theory, but if you don't use it, you're not going to get any, it's not going to give you any benefit, right? So what happens is people make a trading model, or they come up with a trading idea or whatever, and they don't stick to it. They let their emotions get the best of them. They hold on to their losers for too long, or they'll sell their winners too early. A lot of people are successful trading on paper, but when it comes to real trading, things turn around, and that's because of the emotions. And just think about this, right? Say you have a paper trading system, and it tells you you're going to buy 1,000 shares of a $10 stock, and you're going to sell it if it gets to 15. All right. So on paper, you watch it. Oh, it's at 11, it's at 12, it's at 13, it's at 14, it's at 15. Now I sell it and I got a 50% gain. Now this is easy. All right. But if you have real money on the line, now all of a sudden it's, wait a second, I bought 1,000 shares at 10. Now it's at 11. I could sell and have $1,000. Or it's at 12. I could sell and have $2,000. It's at 13. You know, now I can make $3,000. That's like real. Now we're talking about real money, you know? So the emotional thing is why most people aren't successful. And the people that are successful understand that. So it is a very important thing. And a lot of times, Rodrigo, I'll ask people, like why did you make a mistake? Why did you lose money? And almost inevitably, the answer is, well, I guessed. So we don't want to guess, right? We want to have a logical reason to get into trades.
Right. That happens a lot, especially when, new traders come in and look, 2020 spoiled everybody, right? And then things get back to reality and, it's not that easy anymore, right?
Yeah, the rising tide lifts all boats, So there's, market gurus are a dime a dozen when things are going up, but when things start to fall apart, it's not that easy. And we've even seen like other trading schools, pay big fines for misleading students or misleading about performance and so forth. So for people like that, it was probably, oh, the market's going up. This is great. Everything is easy. But now things turn around. It's like, oh boy, what are we going to do to fix things? Oh, we better revert to lying and being deceitful or whatever. But yeah, it's you're right in a lot of ways, Rodrigo. Like the 2020 crash kind of spoiled people because it made people think, oh, big deal. If the market goes down, I'll just hold on and ride it out. Things will be back to normal in another month or two. So yeah. So but now we're in a whole different thing, man. We're in a whole different ballgame, right? We didn't have this massive inflation, up until whenever. So yeah, so it's a whole different ballgame. Everyone's a genius when the market's going up. That's the old saying, the rising tide lifts all boats. But now we're in a different market. But that's okay. In a lot of ways, it's easier to make money in down markets because markets go down much faster than they go up. So I think a lot of the students are finding that, Rodrigo, it's easier to make money on the short side.
Yeah, no, definitely. I mean, that has made a huge impact. I mean, at least for me trading. And so, Mark, I mean, let's take this time here to kind of show the folks a little bit, like, a little bit about your thoughts on the markets so that they can get an idea really of what to expect in the trading school, right? As you go through the classes and the chapters with them, right?
Well, I'll just kind of keep continuing on what we were talking about because, this is what this is what's going on now. We got the CPI coming out tomorrow, and we have the S&P 500 sitting right at important support, all right, the bottom of this range. So I see things that tell me that there's a good chance this breaks. All right. And what are those things I see? Well, one is we looked at, this whole inflation thing. I think inflation's got to be higher than what they're telling us. 8.5%, but this is up 50%. We looked at this where we see markets can go down for farther and longer than people think. We got Apple, the biggest stock in the market, trading below an important level. We have significant weakness in the financial sector of the market. We have 10-year rates are back above 3% now. So now the question is, well, what does this all mean? Well, I think it means that if the 408 level on SPY gets taken out, we can have a decent sell-off, size sell-off tomorrow, especially because it's a Friday and, things tend to accelerate on Friday. So, if we break that 408 level, I think we could be heading south. And I don't see anything that could come out of the CPI report that would be considered good, because if it's at or above estimates, people are going to say, inflation's out of control. Inflation's really high. If it comes in below estimates, people are going to say, oh, the economy is really slowing down. So I don't understand, or I don't think there's anything that I don't think that the market's going to think it's good regardless of what it is. So then we start talking about, all right, well, if we're going to have a market that's going lower, how can we position ourselves to make money? And one of the ways could be to buy the S triple Qs. I mean, I wouldn't say buy them now. I would wait to see this level get broken first. But this is what we talk about when we say we're letting, the market give us the ideas. We're not just guessing, oh yeah, the market's going to go down. Maybe it goes up, maybe it goes go down. Let's flip a coin. We're not guessing. It's just that the way markets work is that when support breaks, they tend to make big moves lower, and we're sitting right on support. So, you could kind of see it here. This support breaks here, and then we have this big move lower. So this is what we're going to be looking at, and this is what we're going to be talking about tomorrow morning. I would imagine, right up through the release, which is at 8:30. So it should be a good one, Rodrigo, or
Right.
an interesting one, I should say.
Absolutely, man. Absolutely. And I mean, today the class was very, very interesting as well. And look, I mean, that's the thing, because even though it's called the trading school, I mean, we're learning, we go over chapters as a team, right? That's full commitment, teamwork. But then you also, review trades from the chat, from the people, from the students, and give out trade ideas. So it's just such a different way of starting to trade compared to like what 90% of retail traders experience, which is learning by blowing up their accounts or doing, that sort of stuff. Unfortunately.
Yeah. It's I don't know. It's when it comes to money, people just think irrationally. You see people that'll spend weeks, like if they're shopping for a washing machine, to try to save $100 or $200. But then that same person will go in some chat room and, someone they don't know says, hey, you should buy this stock because of this. And then they'll throw, $5,000 at it without even thinking about it. So money makes people do irrational things. But if we focus on these fundamentals, what price levels are important, what trends are intact, and what's the momentum driving them, then we get a good roadmap of what is going to happen in the market, right? Like, for example, if we start to break down here, where would we be looking for a bottom? Well, I would say, where we had this prior bottom. So SPY breaks 408, next stop could be down here around 390, which is where we had our bottom here. So I don't see anything that would be really well defined in there that I think would put a stop on it. So yeah, I mean, to me, it looks like the market's kind of set up to make a move lower here. Okay, so so if this does start to go lower, then some students might buy SH, which will trade inversely. So if this goes down 1%, SH will go up 1%, right? So we can use inverse ETFs. Right. Some of the students will be buying puts if we start to go lower. Some can maybe be buying calls on the inverse ETFs or the leveraged ETFs. There's really no right way to do it. People have different styles and people have different personalities, and what works for one person may not work for another person. So there really is no secret formula. You got to do what fits your personality. Like, think about this: if you made Tom Brady a linebacker or a defensive tight end or a defensive end, he probably wouldn't be very good at it, but he's a great quarterback. You have to do what fits your personality. And some people, Rodrigo, we have pretty much the whole gamut, right? We have everything from really short-term traders to people that are more long-term buy and hold investors. So it's called the trading school, but it should be like the trading / investment / financial market / risk psychology or investment psychology school.
Well, the thing, Mark, is that there's so many, and look, I understand, man, because like when I started trading, I was, you really try to find resources, and then you find out that you're overloaded with a bunch of stuff that you don't need, because really, there wasn't a trading school, when I started trading, but obviously this would have been the best way to do it, because of the whole experience that you have with the students. And like I said, man, there's a lot of these TikTok kids and YouTubers and all these people that they're just, I guess, misleading people, I guess. I don't know, like pumpers, but ultimately, like what we're trying to do here is educate traders so that they can make, they can be successful independently, right? That's the whole purpose of the school, right? And that they stay with us, with the community, trade, all that stuff, Mark, right?
Yeah, yeah, absolutely. Um, yeah. Here's the thing, right? I guess you get the whole range of the gambit. You get everyone from people that are maybe they think they're doing a good job, and they're trying hard, but they just don't have the experience that someone like myself does. Um, and then you get the other end of the gambit, which is people that are just bold-faced liars. And they don't care. They're just want to make a sale. They lie about performance. Um, but my experience is it's not just trading with Mario and Steve. I was also the head of trading at 3 different institutional money managers, and in those money managers, we had all kinds of various strategies. We had various hedge funds, mutual funds, option strategies, currency, commodities. So there's really not too much in the trading world that I have never seen. So I just think that I just have a lot of really good experience that translates really well into helping people learn about the markets and what really goes on Wall Street, not as opposed to some of these myths that are going around. And so, yeah, so what really goes around, what I think it's really funny when I hear people talk about market makers, Rodrigo, because I spent 2 years as a market maker. And I had no idea that every morning I went into work thinking, oh, gee, how am I going to rip off the little guy today? You get this whole thing like, oh, the market makers are doing this, the market makers are doing that. People just have a misconception of what a market maker is. A market maker is at a broker dealer, they have different people or different teams that specialize in different stocks. If, say you wanted to trade a industrial company and I call up Goldman Sachs and I say, hey, I want to buy a million shares of Dow Chemical. Well, that's going to go to their market maker, the guy or the girl or the team that are the industrial market makers. Those people, all they do all day is trade the industrial stocks on behalf of their clients. The reason why and the clients being the hedge fund or the money manager, the reason why they called them market makers is because people like me would call them up and say, hey, I got something to do on Dow Chemical. And then I got something to do. Do you got anything going on? And then it becomes like you try to feel each other out kind of a game. The market maker is going to say, well, what do you want to do? Do you want to buy or do you want to sell? And I would say, well, make me a market. So that's where the term comes from. Make me a market on 1 million shares. Okay, you want a market on 1 million shares? I'll sell you, last price is 66, 67. I'll sell you 1 million shares at 67, or I'll buy 1 million shares at 66. That's the market on the 1 million shares. So that's where the term comes from. And market makers do not go out there and just try to rip people off. Your main job is to execute the trade on behalf of your client. And if market makers start playing around with their own money or their capital, things can get really nasty. Look at that. There's a clear resistance level. For example, and I've seen this happen. Say you're the industrial market maker over at Goldman Sachs, and it's a slow day, and you're like, oh, I think this stock is going to go down. So let me go out there and sell a bunch of shares short. I'm going to sell, 100,000 shares short. So you go out there and you try to sell it. And then all of a sudden the phone rings and it's a client. Hey, I got to buy 3 million shares of Dow and be really aggressive. Take it up. I want to get the order in. And the market maker is going to be, well, I'm short here. Can I go along with you? And 9 out of 10 times they're going to say, no, I don't care if you're short. So the market maker is ultimately beholden to the client. And if they're trying to invest their own money or use their own capital, things can go very wrong very fast. People talk about algos. It's the algos taking it up. Like algos are neither good nor bad. They're just tools. It's like if you're a carpenter, you have a hammer and a screwdriver. Well, if you're a trader, you use various algorithms to make your trades. You might have on the simplest side of your algorithm, you might have, all right, well, just buy 10% of the volume, and just get me the average price. So if that was the case, this is traded 1.2 million shares today, you would have 126,000 shares. It would be, in your algorithm, right? You could have an algorithm that you can program to say, all right, well, buy 10% of the volume, but if it starts to go down, get more aggressive and buy 20% of the volume. Or you could have it conversely, buy 10% of the volume, but if it goes higher, back off a little bit and only buy 5% of the volume. Now, some algorithms are good, some algorithms aren't. The algorithms are created by brokers like the Goldman Sachs's of the world, right? So they have their algorithms and they go out and they market them to their hedge funds and say, hey, you should use our algorithm. We have the best algorithm in the world. Now, you could have algorithms that work well, and you can have algorithms that don't work well. Now, my forte in trading was illiquid micro cap and small cap stocks. I did a lot of other things too, but so because we're trading illiquid things, and we might have to buy 1 million shares of a stock that only trades 50,000 shares on a day, I would have an algorithm that was very aggressive, where I would set my price limit and it would just say, if I could buy all the shares, just go out there and just do them. All right. Now, when I use the Bank of New York algorithms that they had on our desk, they work great. I would put out my order and it's just like, bam, bam. You see the shares just start coming in like 5,000, 10,000, bam, bam, bam. I could use an algorithm from another firm that might suck. I could put in the same order and the same instructions, and I don't buy any volume. Now, why is that? Why is it would one algorithm produced by one bank do very well, another algorithm made by a different bank with the same exact strategy not do well? The answer is because of market fragmentation. You're going to be hearing that a lot over the coming weeks because of the whole thing with the SEC and selling order flow. But I'm sure you've heard the term dark pool, right? A dark pool is neither good nor bad. A dark pool is a private exchange, right? If you're a big enough firm, you say to yourself, well, you know what, why pay the stock exchange to fees to get trades done? We're just going to make a dark pool. It's going to be like our private exchange, right? So Goldman Sachs, Morgan Stanley, they have all their dark pools, right? Now, there's probably, last I heard, there's like 60 or 70 different venues where a stock can be executed on. You got the exchanges, you got the dark pools, you got what we call the ATSs, the automated trading systems. So the difference between the good algorithm and the one that wasn't good is the good one was linked into a whole bunch of these different pools of liquidity, whereas the other one might only go into one or two. So, I don't even know how they design it. It's like, well, you're Goldman Sachs, you want all your clients to have access to your dark pool. But do you want Morgan Stanley to have access to your dark pool? Well, maybe not, because Morgan Stanley is a competitor. So you're not going to do stuff to help your competition. So this whole like, this like the algos do this, the algos do that. It's really just a it's a statement that just kind of really doesn't make sense. Like algorithm, like when you put in your order with TD Ameritrade or whatever you're using, it's going into some algorithm. It's just an algorithm is like, it's not good nor bad. It just is. And I think the whole thing with the dark pools is kind of funny because dark pools first started to come around in the early 2000s. And again, dark pools are run by general or brokers, or buy side firms that have enough size or whatever. But so when all this stuff came out in the 2000s, the broker's pitch was, hey, you should use our dark pool. It's dark, meaning people aren't going to see your trades. But the reality is that's a completely false idea, because if you're in a dark pool, the trade still needs to get reported to the tape. You're still going to see it trade. Plus, the people that are working at the dark pool are watching your trades. The developers are watching your trades. So dark was originally meant to be like anonymous, but I think now when people hear dark pool, it kind of gives us, like, oh, it's dark, so it's got to be evil. I don't know. What do you think, Rodrigo? That's what I think. There's a lot of confusion about things like that.
Yeah, there's, I mean, not in that and many other things. But that I think happens a lot, when people like, I mean, when you're trying to find information and you just go read whatever you can get your hands on. But ultimately from I talk to thousands of traders, the experience is that like as they start getting a little bit more um familiar with like the markets, then they start cutting down on things because they're like, hey, you know what? I don't need this. And then they just keep the quality stuff, right? And pretty much that's like, the way I look at, and many people as well look at Benzinga, right? Things like the trading school that like, it's not like you get, number one, you get Benzinga Pro with the trading school. So you have the best market research terminal out there, right? To find stocks, scan stocks, all that stuff. But more importantly, you actually have a former hedge fund manager that's literally there with you all day. Well, I mean, for about 3 hours a day, and live trading rooms as well with entries and exits. So it's ideal for anybody that's trying to get started. Especially right now with the volatility. It's just not a good time to wing it. It's not. Maybe 2020, I'll give you that, but yeah, I think it's really helpful, and I know the students themselves are really grateful of all the stuff that you've done for them, Mark, helping them.
Yeah, it's good. It's gone very well so far. It's gone very so. I mean, if here's the thing, the only prerequisite is you got to want to learn. This isn't like trade idea of the day or a trade mill or Mark, what do you think of this? What do you think of that? What do you think of this? What do you think of that? What's going to happen here? What's going to happen there? Blah, 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 blah. It's like people that want to learn and teach themselves, because everyone has to do what fits their personality. What works for someone might not work for someone else. So I don't buy this whole thing of like, oh, watch so-and-so trade live, or you can trade live with so-and-so. Big deal. I mean, who cares? If so-and-so can do it, doesn't mean that you can do it, the other thing too about that is part of being successful is understanding that losses are an inevitable part of trading. You can't come into it with this mindset of like, oh, a guy like Stevie Cohen, oh, he must have this secret formula that he uses that's always right. These guys at these big funds, they lose money on a lot of trades too, right? They just have the risk management better. They don't have big losses, right? They have small losses, they have break evens. When you are going to invest in something, right? Basically one of five things are going to happen. You're going to break even, you're going to have a small loss, a small gain, or a big loss, or a big gain. The break evens and the small losses and the small gains all offset each other. If you can eliminate the big losses, then your big gains is going to be where you make your money. And that goes back to our whole concept of investment psychology. So, human instinct is you buy a stock and it starts to go down and you're losing money. And you say to yourself, I made a mistake, but I don't want to lose. I'm going to just hold on to this thing and I'm going to hope it gets higher. And it continues to go lower and it turns into a big loss. That's one of the biggest mistakes people make, is they hold on to their losers for too long. The other side of the coin is people sell their winners too early. Like you might say to yourself, like the example I gave before, I'm going to sell it if it gets to 15. Well, on paper, it's easy. But in real life, it's like, well, I bought 1,000 shares at 10. Now it's at 12. I'm just going to take my $2,000 profit off the table. And then you sell and then the thing goes to 15. So it's a lot of it is understanding, like we always talk about in the class, like if a student has a loss on a trade, like why did you lose? Like what happened? And inevitably I'm gonna hear, well, I sold it before I got to my price target, or I didn't follow my rules, or I guessed. It really, the investment psychology part of it is really what the real secret is. If it's not about having like a secret system that always works. It's about understanding how as human beings, we haven't really evolved in a way that's conducive for trading. Maybe 20,000 years ago, fear was a good instinct, right? You'd be walking down a trail and a saber-tooth tiger would come out to get you, and you get fear and you get adrenaline, you get jacked up, and you can run really fast. Right? So maybe fear has an evolutionarily good purpose, but when it comes to markets and money, when people get afraid, it makes them do stupid things and make mistakes. It makes them hold on to their losers for too long. It makes them sell their winners too early. So yeah, so the psychology class, and that's our is that our Monday class, or no, that's our Tuesday class. Yeah. So yeah, so psychology is pretty much the ultimate secret. Like, if I could say in one sentence or in one paragraph, like, what is the ultimate secret to trading, I would say it's understanding that as humans, we have not evolved in a way that makes us conducive to manage money, because when we get afraid, we make mistakes. And just think about, like, people have a herd mentality, Rodrigo. Like, I think this is pretty interesting, right? You're driving down the highway, and everyone who drives will know this. You're driving down the highway and you come up to a toll booth, and there's 10 different lanes, but there's like 30 cars going into one lane, and everyone just jumps on that line. And you say to yourself, wait a second, those lanes up there, they got green lights. Why isn't anyone going through them? And you break out of the line and you go and you drive through there, and you don't have to wait online. So it sounds like a silly example, but it shows how people tend to have this herd instinct. You're not thinking clearly. You're driving along, and all of a sudden it's like instinctually it tells you, oh, you better get online. But if you could break away from that emotion and you could look up around at the lanes, and you could see that you could go through one of the other ones, you're going to be ahead. So it's the same thing with the market. I think a lot of people, they get susceptible to the herd instinct or the herd mentality, and that makes them do illogical things, Rodrigo, like, buy stocks based on what someone in some chat room somewhere says.
Right. And yeah, that happens a lot. And I guess new traders are the most susceptible to make, like, there's a million ways to lose money in the markets. And it's, if you want to go ahead and experiment how many ways you can find out, go ahead. The market will charge you a tuition. And if you don't really get the education at one, that the market will make you pay an unlimited amount, right? It does not care about your emotions or your feelings, or it's pretty much, you have to approach it from a professional perspective, Mark, right?
Yeah, no doubt, man. Yeah, no doubt, because things could go bad pretty quickly. And a lot of times people are almost better off in a lot of ways if they maybe lose money on their first trades and then try to come into a school like this. Because I've seen a lot of people that have frankly have crashed and burned because they got arrogant. They started out with success and they thought, oh, this is easy, or, oh, I'm smarter than the next guy, or I can outthink the market. And, they start out good, and they just, pride comes before the fall, right? So I've seen as many people I don't know about as many people, but I've seen a lot of people be destroyed by success. So you have to always keep an even keel, because it's like you said, yeah, the market really doesn't care about you, and the market is never wrong. So we have to come into every day kind of being agnostic and trying just to keep things in perspective. So that's why it's good to have a class every day. So, just we can talk about things as things develop and things move around and so forth and so on.
Right, Mark, and you are a CMT as well. You've been a chartered market technician for about like 20 years, right?
Yeah, I think even longer. Probably maybe 25 years. So, but even in the CMT class, they teach a lot of stuff that is, I would disagree with, frankly. Like they teach like some of this crazy stuff like Elliott wave theory and GAN theory, and that stuff's not valid, man. No one in the real life institutional world uses GAN theory or GAN charts or something that looks like, yeah, like no one in the real trading world uses stuff like this. In the institutional world, Elliott waves, impulse waves. I don't even know what this stuff is. And these GAN patterns. And the thing about GAN, like this GAN box, like I don't even know what a GAN box is, right? But me being the person that I am, when I started studying all this technical analysis, we learned about this GAN stuff. So it's like, oh man, who is this guy GAN? People will tell you he's this genius, that he made, huge fortune. He had all these secret trades, blah, 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 blah. So me being the person I am actually got some of GAN's books that he wrote back in the 1920s. Now, listen to what I'm saying. These are books by GAN, not books about GAN. And GAN was an unsuccessful stockbroker who started a newsletter. And I think it was Alexander Elder, met his son. Elder's like a well-known trader guy. And Gan's son said, well, when he passed away in the 50s, he had a net worth of $2 million, which was a lot of money back then, and it's a lot of money now. But he certainly was no, secret, super secret genius or anything like that. And I would be willing to say, if you were to show Gan himself, hey, here's a Gan box, he would be like, what the hell are you talking about? Because there is nothing like this in any of his work. I read every book he wrote. I think he wrote 5 of them. There is nothing like this in his books. So I don't know where this whole mythology came along. He wouldn't even know what this is, right? And I don't know how to use this stuff. But it's bogus. It's not valid. And in a lot of ways, I think that this kind of it's an embarrassment to our profession in a lot of ways, because this is not astrology. What we're doing here when we look at charts is we're studying supply and demand dynamics. We get that from logic and not this stuff, or Elliott waves. So I mean, people ask about this stuff, and I teach them what it is, but I also tell them, in my opinion, there's just no validity to it. We focus on trends, levels, momentum. It's not about whatever this thing here is. So yeah, so anyway, so I think that people that believe in GAN theory are really just intellectually lazy, because all you got to do is buy one of his books and you'll realize that it's nothing like perceived. And it, like GAN was a really hardcore staunch Republican, and in the 30s during the New Deal that FDR was putting through after the Great Depression, he hated FDR, and he wrote about how the New Deal is going to destroy the country. I think the Dow Jones was at like 236 or something like that, and he said, the Dow Jones will never surpass this again. We're going to go to war with Russia in the 1950s. So he was wrong about a lot of stuff too. And I respect the guy because he had a successful newsletter. But I'm just saying there's a lot of myth and stuff that is a good way to waste your time. So, I mean, if people want to use GAN theory and Elliott wave, fine, they can make money from it. I think that's great, but that's not something that that we talk about. It's just,
right. And
it's like it's science fiction. Go read a Ray Bradbury book or something if you want a science fiction. I mean,
yeah, that's just like the people that come into the. I mean, I love the take, Mark, and I guess that kind of goes along with when like new traders come in somewhere, anywhere, and they're like they think there's a secret formula, and you being the chief educator at the Benzinga Trading School, I mean, you're firsthand watching this, right? So there's just such a disconnect, I guess, right, between consistency, right, and then for some reason, the way that retail tends to trade in most cases, right?
Well, I don't, yeah. I mean, I don't know what it is, I mean, it's like, why do people believe in, I don't know, the Loch Ness Monster? I guess people just want to believe in that there's like a secret way to do it, or some secret formula that they can stumble upon. And that's just not how it works in the real world. I mean, Babe Ruth struck out more than any other baseball player, so think about that, right? Greatest baseball player of all time strikes out more than any other baseball player. So it just shows you losses are part of the game. It's, you know, people come in here thinking like, oh, you know, what's a successful win rate? You know, I mean, if you do it right, you could be right on, you know, 20% of your trades, you know, and lose money on 80%. Well, you could still come out ahead if you let those 20% that you do well on, let them go, you know, let them get to your price targets. So yeah, I mean, I guess people want to be lazy, or people want to think that there's like a secret formula, or people want to be told what to do. But that's just not the case. That's just not how it works in the real world. So yeah, it's just you know, there's a lot of myth. There's a lot of, you know, Wall Street wants to make stuff sound complicated so they can charge fees. You know, I could see why people get confused, because there's so much noise out there. And when I first started considering doing this trading school, when I met you guys, I remember like looking at a bunch of the trading schools online and just thinking like, this is all garbage, man. You know, like these people should be ashamed of themselves. And, you know, as we've seen, right, two of the biggest ones have admitted to guilt and have paid big fines for misleading their people. But yeah, dude, so there's a lot of garbage and a lot of noise out there. So I can understand why people are confused. But you know, I think that's a good reason why they should come to the school, because I can teach them how, you know, maybe not like how to have 100% success rate, but I can at least teach them how things on Wall Street like work in the real world and not just in mythology or whatever. So yeah, so it's I guess, as you would say, it's a multi-dimensional class, Rodrigo.
It's and look, I think that's just the human factor of this, right? The human factor of trading, of emotions, of decision making in high stress times, right?
Yeah, yeah. So I got to actually wrap things up because I got to go into a meeting. But I just want to say before I go, I hope to see some new people tomorrow. It's going to be a really interesting day. And the CPI number comes out at 8:30 in the morning, and class starts at 7. So we'll certainly still be going. But you know, we could get a lot of things moving around tomorrow. And that's where we get our opportunities, right? If that 408 level starts to break in SPY, let's take a look where it is now. You know, that's going to spread throughout the whole market. Or I mean, it could spread through the whole market. Yeah, and look at this. We're at the lows of the day now. So let's look at the one-day chart of S&P. This is just what we've done today. And we could see we opened, but we're at the low trade of the day. So we might be selling off here going into the close ahead of the number tomorrow morning. And again, I can't picture a number that's going to be greeted by bullishness. It's either, like I said, it's either going to be inflation's in line with expectations or above expectations, which is bad, or inflation is below expectations, and people are going to say, well, it's due to an economic slowdown. So I don't see anything good. But all of that being said, if we see the market start to take off, and if we see Apple start to break that 151 level, you know, that's the market telling us, hey, man, you're wrong. I'm going higher. So you can sit there and you can second guess yourself, or you can jump on board and try to ride along for some profit. We always have to let the market ultimately be the decision maker to what it is that we do, right? We don't want to guess. So it should be it's going to be a pretty interesting day, I think. I would be surprised if we don't see some kind of a big move tomorrow.
Yeah, absolutely. And for those guys, I want you to know I'm going to play the live class. Mark has to go do some things, but I'm going to play the live class from today from the trading school so that you guys can see how the actual live class is, what he goes over and all that stuff. Mark, thanks a lot for your time here, man. I'll see you.
All right, Rodrigo. Thank you. And thanks everyone for listening.
All right, man. Thanks a lot. All right.
Okay, so long.
Okay, all right. I'm putting I'm putting in the class right now. 1 second, folks. All right, you should be able to see it there. Let me know in the chat if you can see that. If you can see the screen of the like recording there. Okay, all right, I think it's there. I think it's working. All right, so guys, I'm gonna show you the live class that happened today. This is, we can either watch the morning one or the afternoon one, whichever one. I'm gonna put the afternoon one because it's gonna be a little bit more relevant to what's happening right now in the markets, so that you can kind of get a sense of, what gets discussed, right? Even if the markets are tanking or going up, all this stuff gets discussed, analyzed, and studied in the school, right? So let's go ahead and carry on, folks. Let's go. Now, if anybody does want to join the school, keep in mind there is a 7-day trial for $7. After that, if you want to keep it, it's $14.97 for the year. It's going to stay the same price at the next year at renewal, right? So, and you get Benzinga Pro, which is like an amazing tool. But let's go ahead and find this thing from today. There we go. Momentum. So it's the class from today. Really quick, guys, for you to know, what the chat that you're seeing on the right side, that is a live chat that is just for the class, just for the live class. You have separate chats, which I'll show you here. You have separate chat rooms here where you can see Mark's trade ideas, questions for Mark. So if you have a full-time job and you can't go to the live Q&As, you have a dedicated chat room to ask Mark any question whatsoever about, the trading or the class or the lesson, anything in particular that you have a question on. Student chart of the day. So the folks here are putting their own charts and all that. Student plan, project chat. So this is, I believe, a trading model that the students have developed. I'm telling you, there's a lot of great things happening there. You got to check it out. Questions for Mark. We went over that. Mark's trade ideas. Okay, so I got a really nice trade here from Mark. He put it a while back ago, though, a couple of weeks ago. I think it was Kimberly Clark right there. So this was on May 2nd. He put it out there. So eventually, Kimberly Clark did gap down. I think it's like at 130 right now, or 129 around there. So it did close the gap, and that was a pretty easy, puts that I bought on it. So you can find trades from Mark in this chat room, Mark's trade ideas. Class files, if you want to quiz yourself, you have all the quizzes there that you want to, like every chapter has a quiz. So you can quiz yourself and actually see where you need improvement. This is actually an important, thing to do, because you can kind of see, hey, I thought I knew this, but I guess I don't. Or maybe I have this confused, but I thought that I didn't. So it's very good. It's very good. No, it's 14. So $7 for the first 7 days. That's the trial period, Rowan. After the 7 days, if you want to keep it, right, it's $14.97 for the year. So $1,497 for the year if you want to keep it, if you want to trade with the school, right? The 7 days, $7 is basically a trial period where you money back guarantee period. So let's go ahead and get on the class here. Video library, momentum, and gotta give a quick shout out. Okay, so quick shout out there, D Wagabaza for joining here, and Jerry also, welcome to the family here, Jerry. Let's go. All right, let's go ahead and get the session started, guys. This is, again, from noon, so from 12 to 1 p.m. Eastern. This was from today.
Hello, everybody. I just want to make sure you can hear me. Okay. So Lindsay, you're in the Bronx, right? I believe, because I'm going to go into Manhattan tomorrow to meet up with Andrew from the UK. So probably just meet somewhere around Grand Central and just have a couple drinks or whatever. Because I got to get back to Connecticut before it's too late. But yeah. So if you're around, I'll let you know where we're gonna meet up. But like I said, somewhere around Grand Central, some bar. I like the dive bars. Okay, so all right. Well, it's only 12 o'clock, so I guess we'll give it a few minutes for people to come on in. ECB plans July increase as inflation problems deepen. Wow, not too much out there to be excited about. Record fuel prices upend businesses and economies. Leverage loan stalls, buyout boom. U.S. considering reducing tariffs. Okay, like, are you going to keep considering this for how long? Deloitte explores splitting auditing and consulting arms. Inflation comes from America's yards with lawn care costs of 22%. Yeah, I know. The guys that cut my grass are jacking up my bill. It's getting to the point where I'm thinking I'm just going to go buy a lawnmower and just do it myself. Which companies can raise prices without angering customers? Well, this should be pretty interesting. I don't know if that's possible. The standouts. Positive correlation, negative correlation. Well, I don't know. I think that's pretty ridiculous article. Which retailers have the most excess inventory? So now this is an issue here too, right? That's another source of us telling things that are slowing down. Target warned that its profit would drop because it needs to cancel orders with vendors or to offer discounts to clear out unwanted goods. So, I don't know if this has anything to do with the supply chain or if this is just a slowdown thing, but inventories are building, right? And we can see that here. So this would be the inventory to sales ratio, which is something that fundamental analysts look at. So we can see that although these numbers don't appear to be big, the changes are significant. Like, for example, Amazon went from 0.2 to 0.3. It doesn't sound like a lot, but if you think about with demand, shoppers have shifted their spending from casual wear, catching some retail apparels offline. So this is another bearish thing for the economy here. Look at this inventory to sales ratios for Home Depot and Lowe's. A lot of fundamental analysis consists of looking at ratios, believe it or not. There's a lot of financial metrics like the price to earnings ratio, the price to sales ratio. Here we see the inventory to sales ratio. And what they do is they'll look at a particular company and say, how does this stack up against other companies within the industry? I'm interested in buying a retailer. Which one should I buy? Which one's the cheapest? And they're going to go look through the metrics. They're going to look through the earnings statements. But a big part of it is looking at these ratios. And there are trading models or trading screeners that are based on these financial metrics. Like it could be something like, or the new kind of the new buzzword. Well, it's not that new, but a newer buzzword, I should say, is quantamental, where they're combining quantitative analysis with fundamental analysis. And it would be the type of thing like we think about our trading models, right? Where we talk about, all right, well, if it gets below the RSI and this happens and that happens, blah, blah, blah. The fundamental or the quantamental analyst might say, all right, well, here are my set of parameters to buy something. It's got to have an RSI that's below 30. It's got to have a price to earnings ratio that's below 10. Maybe it's got to be outside of its Bollinger Band. It's got margins that are growing at X percent a year. So this is the type of thing that fundamental analysts look at. And, I guess just for the heck of it, let's go look at Target. We looked at this before. Dividend and stock split history. Oh, they're increasing their dividend by 20%. Yeah, to right size its inventory. All right. Target reports first quarter earnings. So when they look at these things, comparable sales growth, store comparable sales increased 3.4%. So a fundamental analyst might look at this stuff and say, how does Target stack up against, I don't know, what would be its rival, maybe say Walmart? What company is cheaper? This is a big thing to focus on here is operating margins. Operating margin rate of 5.3% was well below expectations. So this is interesting because this came out on 5/18. So it's kind of surprising that this caught people off guard. Oh, I guess I have my time horizon is off base here. All right. Well, forget that then. But anyway, yeah. So this is when we see operating margin. Although operating margin is really what it comes right down to is like how much profit do you actually make off of each dollar? So if they have a margin rate of 5.3, if they have $100 worth of sales, the profit after everything is accounted for, after all said is done, all the fees and this and that and the other thing, taxes, this is the bottom line profit, right? So analysts focus on this a lot. So if this thing is increasing, that's good. If it's decreasing, that's bad. Boy, my timeline is so messed up. It seems to me like this Target news came out yesterday. I must have it mixed up with something else. Some other retailer that fell down. I saw Casey's missed, like we were talking about. I don't know if any of you guys were in this. I don't know if I haven't seen Matty B today, but I think he might have been on the short side of this. Yeah. So this is the type of thing that investors look at. And one of the things that you should keep in mind is if you want to get information about a company, you can just go to the SEC website. So sec.gov. And let's just say we do a search for Target. And then this is going to be all of the things that Target has to file with the SEC. Companies typically file quarterly earnings. I don't think that's a requirement, though. I think the legal requirement is they only have to do it once a year, but it's pretty conventional to do it quarterly. So what is this? A Form SD. Form SD. I don't know what this is. A conflict minerals report is provided. Okay. Their quarterly report. This is what we were just looking at. So this is the type of thing that a fundamental analyst would look at here. And they look for things like trends. Here's your income statement. So generally you're going to see this quarter, and then you're going to see a year ago's quarter to get the comparison. So we can see sales are up a little bit. There's revenue, cost of sales, SG&A is selling, general and administrative. So this here is their operating income, and this here is their earnings, where you take your operating income and you divide it by the number of shares outstanding, and that's where you get your earnings. Now this is a really bad drop off here, because we can see in the first quarter of 21 they earned $4.17. In the first quarter of 22 they only earned $2.16. So that's like a massive sell-off. Yeah. So that's pretty bad. And let's see, now we can look on here. Now this is what's called the balance sheet. And this is where you would look at inventory, would be listed in here somewhere. Oh yeah, right up here. Inventory. So see how their inventory has been growing? Like these are their assets. They have cash on hand of however many this is, millions. Or is that a billion? I guess I got a billion. Well, notice this inventory, right? Their inventory was $10.5 billion in this quarter. That would be, all right, yeah, okay. So this is this quarter. Their inventory is 15 billion. A year ago, the inventory was 10 billion. So their inventory has increased by $5 billion over the course of the last year. So that is definitely a negative sign there. And what do we have here? So this would be their statement of cash flows. And all other kinds of stuff here. So if you're a fundamental analyst, this is what your life is. You basically spend a lot of your time reading this type of stuff. And it's almost like you look at it as like maybe like a forensic accountant. They go through here and they look at this, right? If you're an accountant, or if you're following this company really closely, you should have picked up on this. Because when they reported the first quarter, or well, according to whatever this report here is, in January they were up to 13.9. So between May, they went from 10.5 to January 13.9. So this shouldn't have really been surprising to anyone that this inventory was increasing this much. Like if I was a fundamental analyst, this is something I would have noticed and said, hey, what's going on with the inventory here, right? So whoever was following this company could have seen trouble ahead back in January just by looking at the increase in inventories there. So you can get a lot of stuff out of this if that's what you're into. Some people really dig it. Some people will find it pretty boring. I personally find it pretty boring. But it is interesting, though, to kind of go through here and see if you could find clues. Financial instruments measured on a recurring base. So these got interest rate swaps. This is what I've been talking about with companies have to borrow money to operate. So that's what a lot of this stuff is here. Effective hedges on debt. Pension expenses, pension benefits. earnings, a little bit of management commentary there. All right, so gross margin rate. This is, well, we want to really focus on the operating margin. And wow, look at that. That's like a dramatic sell-off. It went from 9.8. So basically, for every $100 that they had in sales back in May of 21, they would make $9.80. Now, for every $100 of sales, they're only making $5.30. So this is a huge sell-off here, or a huge drop-off. Let's see about stores. Well, they're adding stores. There's one here in Stanford. I think it's great. You can go there and buy anything, man. It's cheaper than CVS too. All right, here they talk about their inventory. The increase over the balance of inventory primarily reflects lower than expected sales, as well as impact of supply chain disruptions and demand shifts, whatever that means. This is when we talk about companies have to borrow money to do their day-to-day operations. They're not just taking money out of the cash register. They go into the debt markets, and they do these. Here's their unsecured revolving credit facility that they have with some investment banker. All right. So these ratings agencies, basically Moody's, Standard & Poor's, and Fitch, will say, hey, this is an A-rated company. You know, the odds of these guys defaulting on their debt are practically nil, right? That's what Fitch has here. Moody's has them at A2. I'm not really sure of these scales. But if we recall, what was it last week? That these guys, Standard & Poor's, basically said that what they're seeing is so messed up that they're withdrawing their guidance. So this is a publicly traded company that reports earnings as well, Standard & Poor's. But because of what they're seeing in the debt world, they're basically saying, we don't know what our earnings are going to be. We expect a huge slowdown of like 30 to 40%. So that's where these rating agencies come into play. And the higher, just like with people, the better the credit rating, the lower the cost of borrowing. Like if this was rated B, they would have to pay more money. Let's see, legal proceedings, share repurchase activity. So they're buying back shares, which, people get really caught up on this whole share buyback thing. And I don't think it's like this automatic, like a company's buying back shares. It's means the stock's definitely going to go higher. So you could pretty much learn anything you want to about, well, I don't know about anything, but you can learn a lot about all the financial stuff just going through this. So so this is the SEC here, right? So let's see, Target, Edgar Search Tools. Just take a look at what Walmart has to say. So quarterly report, June 3rd. So this is Walmart. Now let's take a look at their revenue buildup. So that's going to be on the balance sheet. So their inventory went from 46 billion to 61 billion. And let's see what their earnings were. Their earnings went from 220 to 224. All right, so they didn't take the shellacking of the earnings like Target did. So this is what the chief accounting officers and the financial officers of companies do, is they put this stuff together. What is this here? With fuel, without fuel? A reverse repo agreement. A repo agreement is just that it's a fancy way of saying a loan. Like we're going to give you money, but then we're going to repurchase it. Let me see if we can get a good definition. Reverse repo definition. Reverse. Yeah, okay. It's a reverse repo is a short-term agreement to purchase securities in order to sell them back at a slightly higher price. So it's just a fancy way of a way a company could borrow money. So let's see, a reverse repurchase agreement is a purchase of securities with the agreement to sell them at a higher price at a specific future date. For the party selling the security, agreeing to repurchase it in the future, it's a repurchase agreement. For the party on the other end of the transaction is a reverse repo agreement. So repos and reverse are the same thing. It's just one's one side and one's on the other side. So central banks use reverse repos to add money to the money supply. Repos are classified as a money market industry, so they're usually used to raise short-term capital. A lot of times these are literally like overnight or 1 week loan, or reverse repos are commonly used by businesses like lending institutions. Yeah, all right. So that's what a repo is. It sounds more complicated than it actually is. Intel looks, yeah, let's see. We were looking at that yesterday. Intel broke a major support level, and it's converted into resistance. And this level goes back to 20. So if you ask me, the market's looking pretty weak. So SPY is down, testing the bottom part of this range here. So if this 408 level starts to break down, it could get pretty interesting, especially considering that tomorrow is Friday, and we know things like to sell off on Friday afternoons. So that looks pretty weak. And I guess we'll go take a look at the tech sector. Same thing here. We got to watch this here. This is 138.50. All right, so 138.50. So we're sitting right on the bottom of the range here in the tech sector. So this has to tell us that Apple is probably not doing very well. Yeah, see, failed at this 151 level again. Microsoft is probably below 270 now. Trading right at it. This is like the only thing that's really holding the market together here. The financial sector looks pretty weak, right? This downtrend is starting to accelerate. 10-year yields are back above 3%. We got the CPI tomorrow. And notice too, I think I said yesterday that when oil starts to get to its recent highs, that's where you'll probably see some profit taking in some of these oil companies. And sure enough, look at the OIH that we looked at whenever it was. I see it got up to 315, and now it's, so now we have to watch here again, right? Is a former resistance level going to become a support level? And if so, as of right now, it looks like it is. This could set the stage for another move higher here. XOP. A little bit of a reversal, not too much though. XLE, it's down, but it's still in its uptrend. Testing it though. Yeah, so not looking very good there. Okay. All right. Well, maybe next time, Lindsay. Hello, Dan. Haven't seen Dan in a while. Hello, Rod Trades. Hello, Seth and Pat.
All right, folks. So basically, look, right now that was about 30 minutes. So I showed you about 30 minutes of the class, of the second class that we had today, which is, let me look at here, is level. I believe it was level. Momentum. So the class for today was momentum. And we were discussing momentum and several other things because, well, these things overlap, right? Things will overlap. That will happen often. So, but in this case, we are going over the chapter of momentum, right? So this is only 30 minutes. Keep in mind, you have the first class, which we did not go over, which was 7 to 9 a.m. Eastern. And then you have the other class, which is the one I was showing you right now, which is from 12 to 1 p.m. Eastern. So all the times are on Eastern. Keep in mind the 7-day trial for $7. After that, if you want to pretty much continue the journey here with Mark Putrino and the great community we have, it's $14.97 for the year, and you're set from there. You don't have to do it again because it's only one payment for the year, and you're going to renew at the same price. It's not going to change ever. It's always going to be the same price. So if you have questions, I'm going to put my email there in the chat. But guys, if you're starting to trade and you're just trying to learn stuff, I'm telling you, man, this is probably the only thing you need. Forget about everything else, man. You're just overloading yourself with stuff you don't need. I'm from experience. It's just much better to just have a couple quality things, high quality things, right? When it comes to trading, high quality content, high quality information, high quality discussions. That's really what it comes down to, right? So that's what's happening in the trading school throughout the whole day. And we have the live trading rooms, which are open 24/7. Keep in mind, we have an international community at the trading school. We have people from all over the world. So the live trading rooms, the student trade ideas, student, charts, all that sort of stuff. It all comes to life together. And I think 7 days is really more than enough for you to kind of see that. And really, that's why we, try to come out here to help traders, right? Ultimately, this is for retail traders. This is not for, Citadel or a brokerage. This is really for the young, for the average retail trader, right? For that person that is trying to make extra income, regardless where you're coming from, right? Just like stocks, like people too, where it's not where you were, it's where you're going, right? So that's really the approach that I would have here. It doesn't matter what you're doing right now or how, things could be tough. I get it. But that doesn't mean that it has to be like that forever. And I think the trading school is a great platform for you guys to develop some new skill sets, right? Skill sets that are going to help you make money. Those are the skill sets that I would like to know more about, right? Look, if you want to go play guitar and all that stuff, go ahead, do it. You want to learn that, that's fine. If you want to learn how to trade and make money trading, well, come and join us, right? That's what we're doing. Of course, we have a great time. We have a fun time there. Mark is cracking jokes all the time. He's a really funny dude. And it's really good to have that community, right? It's just if you are trading alone, more importantly, you are probably going to be the person that benefits the most out of everyone because when you're trading alone, man, it's I call it vacuum trading, and it's really you're in a vacuum of thoughts, vacuum of trade ideas, where it's just you, right? And you're kind of you can drive yourself crazy doing that. So I think it's important, guys, that we keep in mind that the education is there for a reason, right? There's no skipping it. It's just being lazy, right? It's not cool to skip this class, all right? I'm telling you, this is not cool anymore. Why? Because this is a class that's going to help you make money literally, all right? We're not teaching you biology here or photosynthesis and none of that. We're showing you how to make money in the markets. It's very simple. So once you get into the group, if you want to trade with Mark, keep in mind, we do have the live trading rooms. Those are 24/7. And in the actual live classes, you can ask him any question about a trade or about a stock. Keep in mind, this is a two-way street. So Mark is talking to you, you're talking to him. He's going through the lesson. Somebody has a question in the chat. Great, let's address it and let's make sure that the student finishes this class and has that question answered. Because really the approach here is that no trader's left behind, right? It's been for too long that retail trader gets the short end of the stick for all this stuff, right? You know the numbers. I mean, some crazy number of how many retail traders fail and blow up their account in the first year. These are horrible numbers, tragic. So really, that's the whole point. We're trying to change that. We're trying to help retail traders improve their own situation, whatever it is with trading, because I don't know what the end goal is for you, but if trading can help you get there, man, I don't know what you're waiting for. I don't know what else you would be waiting for. You have a former hedge fund manager here that literally traded with Steve Cohen, a multi-billionaire, got up to $40 billion in assets under management at SAC Fund, and then also traded with Mario Gabelli, who has about $35 billion of assets under management. He was named Investor of the Year in 2011. Like, these are multi-billionaires, all right, with a B. And once you start trading around those cash levels, the level of experience, expertise that you're surrounded with, it's just top level. It's top notch. And that's where Mark came from when it comes to trading. So the fact that that is your teacher, your mentor, your educator, it's even, and I mean, you know, I would feel so proud just to say that I took a class with that guy. Really. And it's more than a class. It's like a journey. It's an experience. It's way more than what you see here, honestly. I can't show you everything here because it's just, you know, too much, but it's a great experience. I think you should give it a shot if you're new and you're trying to get into trading, or if your P&L is not where it should be. Well, you know, maybe it's time to try something different, right? Maybe it's okay to ask for help. Put your ego aside. It's okay. We all have to admit it that sometimes, you know, what we're doing doesn't work or it's not working, and we need some guidance, some help, some pointers, right? Some finessing. And that's what you'll get in the school, because we even have advanced traders there. So I think this sums it up, guys. I hope everybody has a great day. Keep in mind, if you are serious about making money, if you're serious about trading, give this a chance, right? Give yourself a chance. Join the school, do the trial. After this trial, stick around with us, because we do live trade. We do a whole bunch of stuff there in the school, and it's just a great environment to be around. So that does it for today. This is Rodrigo. Everybody have a great day. All right. Have a great week. Enjoy, stay safe, and trade responsibly. And I hope I can see you guys on the other side on the school. All right, folks. Have a great day. We'll see you around.